Imagine you did everything right as a federal employee. You saved well, and now you're retired with a solid plan. And for the first several years, everything looks like it's worked pretty well. You're traveling, you're spending time with your family, you're really enjoying the go-go years, which are those early years of retirement. And then one day, you slip and injure yourself. At first, this doesn't seem like a long-term care scenario. It feels more just like a recovery. A few doctor visits, some physical therapy, you'll be right back up on your feet, right? Maybe your spouse is even helping around the house a little more. But recovery takes longer than you anticipated. And now maybe you're not as mobile as you were before. Stairs are harder, cooking is harder. Getting the groceries out of the car and into the house just seems like a really difficult task. Your spouse wants to help, of course, but they can't do everything. And by the time you call it long-term care, your retirement plan may already be under attack. Suddenly, the life that you're having to live looks far different than what you envisioned for yourself years earlier. And I don't want that retirement for anybody. Now, you might be thinking, well, that can't be that expensive. Think again. Over the years of serving retired feds, I've seen all kinds of things that affect a retirement plan, and long-term care is one of the worst by far. Now, not all hope is lost. Planning for this properly could mean that you reduce this risk and still have a really fruitful and fulfilling retirement. So today we're going to talk about some of the misconceptions and where people have some false sense of confidence, and as well as how smart federal retirees are addressing this risk for their plan. When we think about retirement risks, there are a lot of things that come to mind first, like a market crash, for example, or not overpaying in taxes, inflation that could get out of control, and hey, maybe Social Security that could see some cuts here in the future. These are the things that we think of first. But long-term care is a totally different animal because it attacks many of these components all at once. And yeah, any one of these individually, especially like a market crash, could be tragic to a retirement plan. Now imagine if many of these are combined into a single event. And the cost of getting help is becoming more and more expensive faster every year. It affects both financial areas like your investments, your taxes, your income, as well as emotional parts like your sense of fulfillment or your relationship with your family. And it's really hard for us to think of a time where we might not be as independent as we are today. And that's why we call this a retirement torpedo. A downturn in the market or a more expensive project like a renovation than we anticipated, hey, that can create a dent in our plan. But with good planning and the proper system in place, we can often overcome those risks. A long-term care event that isn't well planned for, that can punch a hole right through the hull of our plan. And once a crisis begins, the family rarely has time or the ability to think calmly and think in a strategic way about how to handle these issues. They're making decisions under stress, under time pressures, and sometimes with less choices than is really ideal. Now, before you can plan for this risk, you need to understand exactly what's covered under insurance, how do we deal with it, and what exactly are the components to be thinking about. When people hear the term long-term care, most of them are thinking about full nursing care or an assisted living facility. And yes, that can certainly be a part of a long-term care, especially as you get older over time. But that's seldom where long-term care actually begins. Long-term care often starts quietly in our lives. And this could be someone just needing a little bit of help than another family member could comfortably provide. It could be help with grocery shopping, or cleaning around the house, or doing some cooking, or just more things that we do day to day that sometimes we don't even think about. It could, of course, mean some home care, or eventually progress to actually assisted living. But notice that the trigger is not always a major health event, although sometimes it could be too. Sometimes it's just a slow slip of our independence for things that we've always done. Perhaps it's mobility issues from a previous injury that we had in the past. And talking to a lot of my military people here, we've seen this with clients before, and sometimes it catches them by surprise. And this matters greatly because most people want to be able to age in place in the home that they are comfortable in. But aging in place is not a plan. It's going to require money. It's going to require planning. It's going to require resources both in time and energy, as well as finances to be able to support the life that we really want to live. So the dream is to stay independent, but the plan is to determine what is it going to take for that independence to be reality. And this is where many federal retirees really start to have the misconception about what insurance is going to cover and what's going to be their own cost. Now, I need everybody to hear me clearly when I say this. Medicare is not a long-term care insurance program. FEHB is not a long-term care solution. TRICARE is not a long-term care solution. These are healthcare insurance products. They are not designed to cover long-term care, which is something that comes after you've seen the doctor. These programs are all really great for what they are. They provide medical care for when we see the doctor or the treatment plan that we're on, things like that. But the care that often breaks a retirement plan is not the same care that's provided by the doctor. It's really the care that's needed after the doctor is gone. And what we generally call this is a form of custodial care, and traditional health insurance is not designed to cover this. Now, there are some exceptions, so let's go over those. When we have a medical event, most of the time, this is the first part that kicks in. Our health insurance covers our doctor visits, and we feel pretty good about the care and the insurance coordination that goes within. Now, here's the part that's important for us to know. Medicare, in some cases, in very specific situations, have a skilled nursing coverage that's going to apply, but only for a limited period of time. We're talking about 100 days, and even as that phases out over time, then we're looking at an entire gap of coverage where, unless you're completely healed and you no longer need any help or care after that, well, if you do, now that entire coverage is going to be on you, and that cost is not covered by Medicare, it's not covered by FEHB. Traditional health insurance doesn't cover any of those costs. The only exception is things like medication or periodic doctor visits, but again, that's so limited and generally not the additional custodial care that we're talking about. So after that limited skill care window, this is where the big gap comes, and this is the danger that we're talking about. How are you going to support your lifestyle and the care that you might need? And if you think that it's not common, well, let me give you a statistic. Health and Human Services estimates that roughly 70% of people 65 and older are going to experience some sort of long-term care event. Now, they don't go as far as to define exactly what the event is or the care, but just let that sit for a moment and think about how might that apply to your own life too. Now, once you understand that gap, the next question is simple. What do we do to fill it? There are really only 3 ways to plan for a long-term care event. You can self-insure, where you cover that risk yourself. You can pass on or transfer the risk to an insurance company, or you could do a little bit of both. Let's talk about these. First being the self-fund option. What does it take to actually self-insure this risk? Well, this is going to mean that you're using your own assets, the income that you're receiving from your pension and Social Security and portfolio. You're going to be able to use some of that for yourself, but chances are you're going to have a pretty significant amount of resources that are squirreled away aside specifically for this purpose. This means we can't use them for other lifestyle choices like renovations or traveling or any of the other fun stuff that we like to talk about. Now, here's the biggest thing. This absolutely, and in most cases this is true for all 3 ways, but you have to stress test this scenario. Folks, if you take nothing away from this scenario, please listen to this. You need to be stress testing your plan to understand whether a long-term care event is going to derail your future retirement plan. Saying, I have enough to retire is not the same as knowing what a 3-year long-term care event is going to do and whether that derails your plan. Now, I'll talk more about how to do this here in just a few moments. The second way is to insure the risk. Now, this is where we are transferring that risk to an insurance company. We can do this in a couple of ways. The first is through traditional long-term care insurance. This is the federal long-term care insurance program that a lot of you may have. Something important here is that if you don't already have coverage, health or medical underwriting is going to be a thing here. The insurance company is going to look into your medical history and see what kind of risk are you to them. The other thing that's important for us to consider here is what are the premiums of passing on this risk? We're going to have a cost of insurance that the insurance company is going to charge us. And if you've been on federal long-term care insurance program, you might have seen what's happened to premiums over the last several years as they've started to go up over time. The other issue with that program is it's not open to new applicants. So you might be familiar with the program being closed. This is likely due to the fact that the premiums are becoming really difficult for people to pay, including the insurance company to continue offering. Now, there are other policies in place, like the hybrid plans, which we will talk about here in just a moment. The third way to insure this risk, like I mentioned, is a hybrid. Now, 2 approaches to the hybrid here. First, you simply insure a smaller amount, and you also plan to use some of your assets. This is a half a loaf approach, as it were, so that you're not actually absorbing all of the risk yourself, and neither are you paying to transfer that risk entirely to an insurance company. So typically we're doing a smaller long-term care insurance benefit as well as a potential with these hybrid plans. Now, I mentioned this earlier. There are newer or newish kind of plans out there that come with a premium that is higher or larger right now, but you experience that premium outlay for about 10 years and then you're done. In other words, the insurance company considers that plan paid off, kind of like you pay off your car, and then you get to keep the insurance plan for a potential eventual need. The other nice thing about those plans is that sometimes there's a life insurance benefit if you never use the insurance. So at least your heirs get to have some of that money that you gave to the insurance company back if you never actually have a long-term care event. So what we're talking about here is deliberately sharing the risk. Now, we're not going to dive too deep into which one makes better sense. This is something that has to be developed within the confines of a retirement plan. But you can see here, there's really no perfect answer. Only what kind of risk you're going to transfer and what impact that has on your plan. Will the risk live with you? Are you going to send it to an insurance company? Is the risk going to be on your spouse or on your family? This is where the real planning conversation starts to begin. And let's talk very briefly before I show you how to deal with the stress testing about what I call your family plan. A lot of folks are simply going to rely on their family or their spouse to be able to take care of them and help should they actually need that. Or sometimes, here's my favorite one, hey, my kids will help take care of me. And maybe they will, because honestly, family is a large part of the retirement conversation, especially around our health. But relying entirely on our family creates a lot of risks that a lot of people don't think about. Caregiving can affect someone's career. It can affect their family. It can affect their finances, depending on the situation. And beyond that, what it's going to do is it's going to change the relationship between you and your kids or your family members. This could create stress and strain on those relationships, and often not the best way to go through retirement, changing the way that we relate to the people we care about most. Our spouse might not be physically capable of taking care of us, depending on what we need. Our kids might live further away, or hey, they've got their own kids that they have to spend time dealing with and raising their family. This is where love and planning are not the same thing, although they exist in the plan together. So it doesn't exclude the family, but it does give them a roadmap to be able to help you when you need it most. The planning process will help you determine where's the money going to come from, how much can we afford in long-term care ourselves, do we need insurance, and assuming those variables, how much can we spend today on regular life and not create risk to that in the future. So once you've accepted this and you start to piece together the plan, then you can start worrying about, well, what are we actually planning for? How do we stress test these scenarios? We all know to plan for the things that we want most, like the aggressive traveling for the first 10 years of retirement, or that big renovation that maybe we've been waiting until retirement to be able to do. But people rarely think to model out, what happens if I spend that money earlier in retirement? Can I still afford to take care of myself later on? In other words, how much should I have spent on that renovation? How much can we spend safely today without creating problems for later? You don't need to know exactly what's going to happen, but we do want to start thinking about a couple of scenarios. So think of it like your financial blood work. You're not trying to predict every diagnosis, but you are trying to see what are the potential problems. So let's start with a few scenarios. The first being, hey, you don't need a ton of care, just some part-time help coming to the house, and maybe that lasts for 2 or 3 years. Maybe that's $30,000 a year, $50,000 a year, depending on what it is that we really want to be looking at. And of course, the area that you live in has a big impact on this as well. Scenario 2 is maybe now we're looking at memory care, where it's either you or your spouse are going to need a lot more support. This can get much more expensive, $60,000, $70,000, $80,000 per year, again, depending on the care and place that you live. The other is now one of you needs a whole lot of care, but your other spouse might still be in good health and they still want to live at home and they still have a life that they're living with their kids. And so this can be very, very expensive too, where now we're funding 2 types of lifestyles. And especially in scenario 3, you might find that some compromises have to start coming into play. So I want you to be thinking about, if care happened tomorrow, where's the first dollar going to come from? And where is that last final dollar going to be? And this question matters because long-term care doesn't just happen in a vacuum. Every dollar you need is going to have to come from somewhere. So it could be your portfolio. And if you're selling investments, What's going on in the market? How much tax are you creating? How is that affecting your Part B premiums if you took Medicare? This also affects capital gains in your adjusted gross income. So we can start to see all of the different areas that become affected by an event that sometimes we don't have much control over. And we want to start identifying, hey, even if we are able to take care of that need, am I going to leave my spouse financially vulnerable after I'm gone? When we work with clients, there's a variety of tools that we use to help them understand what exactly could happen. This is just a couple of screenshots, and if you've seen any of our videos, you have probably seen me use these as examples. And we want to be creating scenarios that are long-term care and expensive and all of these different bear market scenarios, all of the bad stuff that could happen, and try to understand what's happening to the actual plan. What is the probability of success over time if this scenario materializes? And this is not the only way to go about it, but we have found this to be very successful if you can create the models ahead of time that incorporate every aspect of your financial picture, the tax code, your incomes, your investments, so that it's all working together in one system. But at the very least, create an Excel spreadsheet if you don't have an advisor that you work with, because that will help you start thinking in the right direction. And once you see the impact, now you can start thinking about, what do I need to do in my portfolio to support my life now and for later? Are my investments still just stuck in the accumulation mode, or have I properly set them up for these kinds of risks in retirement? What is that going to do to my income and tax? How much can we afford on travel? All of these questions start to fall into place. And here's something else worth addressing. A lot of feds think that they are just too young to think about long-term care. And frankly, all ages are good to be thinking about long-term care, because the sooner you start, the more flexibility you have. But if I had to put an age on it, I would like people to be thinking about long-term care at around their 50s, and at the very least, their 60s. This is when the planning really starts to get more critical, because you have less time and insurance starts to become less and less of an option in some cases where you might need to have it. So long-term care is a hard topic. It forces us to think about a life that we really don't want to ever have to live. But these conversations are about your dignity and independence as much as they are about your finances and the way to deal with them. So let's build a roadmap now while you have the most control and options, and while you're still holding the pen. And if you like this kind of content, then consider subscribing to learn more about how to plan a successful federal retirement. Until next time, stay wise and stay wealthy.